All right. Why don't we start with you, James? Why don't you ask your first
All
question?
right, so the first question here, Michael, I've been thinking about this a lot, and I want to hear your thoughts on this. So AI is scaling toward AGI, potentially within years, not decades. And if that happens, a productivity shock could be massively deflationary. But deflation crushes nominal GDP, as we know, is making government debt burdens explode. So in response, governments will have to, or this government in particular, will have to print aggressively and monetize their own debt. So we get the biggest deflationary shock in history, forcing the biggest inflationary monetary response. Where does Stretch, STRC, fit in that world? And does digital credit become the ultimate financial bridge to this paradox?
I think we're living through the digital transformation of everything, and AI is digital intelligence, and we're going to see the digital transformation of labor. In essence, digital intelligence should demonetize human capital. So if you had a massive, millions of people doing a job like driving a car or doing a white collar job, and the AI comes in, it's going to demonetize them, transform them, dematerialize them. There'll be a massive increase in productivity. It is deflationary. There's going to be extraordinary increase in productivity, a dislocation, and a transformation of what people are doing, and they'll migrate. We see Stretch as the digital transformation of credit. Bitcoin is the digital transformation of capital. So as the capital dematerializes to Bitcoin, the credit on top of it replaces physical credit. I think that certainly there's always this debate, should I spend $250,000 on a college education, or should I just keep the money? And I would say 30 or 40 years ago, the money wasn't worth that much. And so the consensus was I should spend the money on education so I can work hard. It's not so clear to me now. It seems like you're probably better off to buy $250,000 worth of capital, or like a Bitcoin. Then in theory, you're getting 20 to 30% a year on that forever, or $250,000 worth of the credit. And if you're going to spend the money on the education, the question really becomes, why don't I just get a digital education for free, or from nearly free, from the AI, instead of paying an institution to educate me? So I think a lot of people will make a lot of different decisions, but it's going to be a reallocation of money from physical education to digital education, from physical labor to digital labor, from physical or traditional credit to digital credit, from physical capital to digital capital. We think that the $300 trillion credit market is broken, and it's you could characterize it as all return, or it's basically return-free risk, because the credit spreads on top of the risk-free rate are de minimis. Like, why would you take 77 basis points to take the credit risk of a company, or 288 basis points to take the credit risk of a high yield issuer? So you could kind of say the credit spread of sovereign debt, the credit spread of sovereign debt is 50 to 350 basis points. That does not cover the credit risk of the debt, of the sovereign debt. The credit spread of the investment grade credit doesn't cover the credit risk of the company. The credit spread of the high yield of the junk, 288 basis points, doesn't cover the credit risk of the weak company. The credit spreads on municipal debt and mortgage debt don't cover the risk of those. So pretty much all $300 trillion of capital is non-performing. And you would think that as people have been forced to either take risk, like on Bitcoin, or take risk on equity, or they're just slowly suffering. And what we see is human nature is, human psychology is, they actually would like to own the credit and not risk the principal. And they haven't had a good option. So we think digital credit maybe is the way that we recruit 75% of the capital in the world to the digital assets ecosystem and to Bitcoin. It's the gateway for them to transition from slow suffocation, right? Being slowly squeezed to death, to something better, and so that's where I think it's positioned right now.
Michael, you mentioned on my show that you could do 1,000 hours of podcasts and we still can't reach some of the people in order to buy Bitcoin. But you seem to be looking at digital credit and instruments like Stretch as the way to sort of reach the mainstream public and the majority. So what is the gap? Like, if that's layered on top of Bitcoin, why is it easier for someone to understand Stretch, and how do you market it? What's the challenge there?
I think chemistry is really complicated. Most people don't understand chemistry, but everybody wears nylon and polyester and lycra, and they like Teflon, and they like plastics. And the truth is, they don't want to understand. I don't think people want to understand nuclear power. They don't want to understand petrochemical. They don't want to understand physics. What they want is a car that's easy to drive, and then they want a dishwasher and a hairdryer. Not 1 in 100 people can explain how an air conditioner works, but they all want one. So I don't think 1 in 100,000 people understands how an iPhone works, but they all want one. So I think the great products are all bought. I don't think people that drink Coca-Cola know how to make Coca-Cola, right? Wasn't the recipe for Coke a secret for 100 years, right? It's the most famous secret. So you don't have to understand it to want it. And I think the mistake is sometimes to think that I have to teach people how to create their own explosives, or how to create their own, heat exchangers, or how to create their own internal combustion engines. And when you're in the hobbyist stage, or the early innovator stage at that point, I think that people want an insanely great, simple to use consumer product that just makes their problems go away, that has complicated technology embedded in it. And so I think that we're moving from the early adopter phase. Imagine people used to create their cars from a kit, or they used to if you were an aviation hobbyist, you constructed your own aeroplane and then you tested it and flew it. And then we eventually got to the point where people just purchased an airline ticket and they got on a plane they didn't build, they didn't understand, flown by a guy, did something that they can't do. And eventually where you end up is, we're just going to have cars that drive themselves, that take us to places when we say take us there. So I think we're moving to that point in digital assets and digital credit and the Bitcoin industry. And bottom line is, billions and billions and billions of people want a company to create a product to solve their problem. And if you want to change the life of billions of people, you create that massive consumer product and give it to a billion people. Sometimes they want you to create the product and then finance it for them and give it to them for free. Like how many people paid for their car in cash or their house in cash, right? They want someone to create a house, and they want the government to finance it with a Fannie Mae, Freddie Mac loan, and then they'll willingly move into the house, paid for by someone else, with credit, built by someone else. But I never seen anybody that said that they didn't want to live in the house unless they built it with their own hands, every part of it. So I think that's the case with most things. And this industry is evolving to that.
I would also add, Coca-Cola was originally successful because they convinced pharmacists to sell it as a tonic against an upset stomach. And the iPhone was successful because they convinced AT&T initially to distribute it. And so for Stretch to initially be successful, it already is, but we had to convince banks to distribute it because that's how products get sold today. And now you see all these layer 3 folks building on top of Stretch. So the distribution is starting to happen even as we speak on a 6-month-old product. And that is another way that Stretch is going to be successful, is using the distribution of traditional finance and decentralized finance.
And catchy tunes always help. So we're going to call up our first audience member, Quentin Yenny. Do we have a microphone anywhere? We'll come to you.
Hello, thank you for taking my question. Quentin from the One Share podcast. So my question is around the regulation of digital credit. If strategy is successful in massively scaling their preferreds like Stretch, you could see a future where those products start to rival government bonds. So my question is, how do you think long-term, what is your long-term strategy in navigating this? And do you think that there's going to be new regulations that will be implemented to try to stop this?
No, I don't think anybody's going to stop it. I think that the government is going to take the position you can't call these things a money market fund. Money markets or stable coins will have to be backed by currency equivalents. But I think that it will propagate as a security or as a yield fund or as an investment fund or with a adjective. Whether we can call it digital money is unclear, but you can certainly probably call it digital yield or digital income. And I think it'll spread through traditional banking systems. I think it'll spread as digital income. I think you'll have digital income securities like STRC, but then you'll see wrappered ETFs. I think it'll spread as an ETP, like the 21 shares. STRC is just a security. I think that it will get built into digital income type tokens or the like. And I think people will create digital savings coins, like people are working on here. And I think that you'll have a set of digital assets regulators, and that'll be one set of types of products. I think you'll see the security regulators will be a different set, and then there'll be a set of bank regulators. I don't think this will be an exercise in anybody. I don't think anybody's really threatened by it. I think it'll be an exercise in getting regulatory approvals to roll out various flavors of digital money and digital income or digital yield. The good news here is the most powerful financial regulators in the world are the Secretary of the Treasury of the United States and the head of the Fed. The Secretary of the Treasury, Scott Bessent, believes that digital assets are the future and is an enthusiast. The head of the Fed, Kevin Warsh, believes that digital assets are the future, is an enthusiast. The President of the United States wants to make the United States the digital assets leader, the crypto capital of the world. So you have the support of the president, the head of the Fed, the head of the Treasury. You also have enthusiastic support from the head of the SEC, Paul Atkins, and the head of the CFTC, Mike Saylor. And I've traveled all around the world. The most progressive set of financial regulators in the world are in the US right now. The most powerful set of financial regulators in the world in the US right now. Just today, the OCC put out guidance. You can see it on X, where they said stable coins are fine. We encourage you to look at them. So the OCC, the FDIC, Treasury, and the other financial regulators and banking regulators in the US are going to be supportive. The UAE is the second most progressive set of regulators. They're also supportive and enthusiastic. everybody else in the world is going to defer to and follow the U.S. Everybody else, the Europeans, the South Americans, Singapore, the Hong Kong regulators, even the Chinese, and I suspect the Russians. I think our enemies will defer to the U.S. I think our allies will defer to the U.S. And I think that the train has left the station. There will just be nuances. You won't be able to represent that it won't be a stable coin, and you won't be able to represent it as a currency equivalent or a money market equivalent, because those are defined terms that have very particular meanings. But I think that digital credit and digital income, digital money will thrive in the digital assets economy. And at this point, we're just going to see a Cambrian explosion of new flavors and types. And you're going to see a very entrepreneurial movement, because, releasing this in Australia will require an Australian issuer or a distributor of sorts. And it'll be the same in New Zealand or Singapore or UAE or every single country in Europe. So there's a lot of work to do, but I don't think there's much controversy or much risk that any regulator is going to crack down on this at this point. I think we've crossed that event horizon, and the genie is out of the bottle. There's broad consensus that Bitcoin is ethical digital capital at this point.
Okay, it's also going to be a win-win-win, right? This is right now, and it's, love to project out 10, 20 years what happens to digital credit, but STRC is a $3 billion asset class. Digital credit is $7.5 billion. Let's say STRC goes to 30 billion. Let's say it goes to 300 billion. It's still quite a small percentage compared to what U.S. Treasuries are. And let's say we get to 300 billion, you have 300 billion people, many of them U.S. citizens, and people all around the world now earning 11%. Perhaps that causes them to save more money. That's good outcome. It brings people up, it increases income. So I don't see why the government would look at $300 billion of STRC and say that's a bad thing. They would be supporting that. And then that money pours into Bitcoin. Bitcoin goes up, so everybody who owns Bitcoin is doing well. STRC does well. Bitcoin does well. People do well. Governments do well. I can't imagine they look at a $300 billion asset class and they say, oh, let's regulate this. People will just be more happy.
Yeah, there's a point to be made that digital credit is not competing with sovereign credit. Digital credit is competing with private credit and junk bonds and unrated credit instruments. And so there's no way a large government will feel threatened. The entity that's threatened is a going out of business private company that's attempting to get a loan and offering 8% or 6%. So it's and that's a huge market, right? Right. The people that are buying STRC at 11 are saying this looks less risky and better than my junk bond portfolio that yields 7. And so it will squeeze probably high yield, low, non-investment grade corporate credit, probably for the next 5 years. And then maybe 10 years out, if it's a, $1 trillion asset class, it'll start squeezing investment grade corporate debt. And 20 years out, it'll be squeezing various types of investment grade corporate debt, high yield, and then mortgage-backed securities and other random types of credit instruments. But it's going to start on that side of the credit curve. And it's the same mistake people make with Bitcoin. They think, oh, Bitcoin, it must threaten the dollar. No, Bitcoin's capital, it threatens someone's like second rate or it's someone's international real estate portfolio or alternative assets. I'm deciding whether to buy oil and gas rights in Argentina or Bitcoin, or I'm deciding whether to buy real estate, in Asia or buy Bitcoin, or I'm deciding to buy, a mixed portfolio of buildings, real estate, and gold, and oil rights or Bitcoin. And when you look at it that way, you realize that it's just a better form of alternative capital, just like digital credit is a better form of alternative credit. The people the banks and the nation states that embrace it will thereby grow and prosper because they're embracing a new technology. And so the confident ones are not insecure. They're not going to be threatened by it. I don't think JP Morgan doesn't think that Bitcoin's going to eliminate its role in society. And the United States is not concerned about Bitcoin. That's why the president endorsed it. That's why Warsh endorses it at the Fed. That's why Scott Bessent believes in it. It's just technology. And to Fong's point, we probably got 20 years before we're at 5% of the market. In 20 years, people will say, here's a new thing, and it looks like it's 2, 3, 4% of the capital in the world. And that's perfectly fine with us.
Thank you, Quentin. Next up is Radu. Got a microphone behind you. Oh, no, behind you.
Okay, so imagine it's the year 2060 and the world is fully on a Bitcoin standard and strategy holds 3 million Bitcoin. The arbitrage window that enabled the accumulation phase has closed. What will strategy's role be in that future Bitcoin economy?
In the year 2060, there's still going to be a lot of capital invested in real estate. There are going to be rich people living in Palm Beach and the Hamptons. There's going to be buildings. There's also going to be companies. There's going to be a company with 1 billion robots that makes robots, and there's going to be flying hover cars, and there's going to be nanobots, and there's going to be a lot of valuable equity, a lot of valuable real estate. There's going to be a lot of money invested in Bitcoin. There's also going to be city and state governments. So I think that world is a world where maybe 20% of the capital is digital instead of 0.1 or 30%. And then maybe instead of, digital credit will be successful, but there'll be other forms of credit. There'll probably still be other forms of credit. Our role will be to support digital credit and then all the innovations. There's probably going to be some brilliant, interesting things that get invented in the year 2045. And then we'll have 10 years to work on that, but we don't know what those are right now. I rather think, though, it seems pretty clear that white-collar labor is getting turbocharged and transformed by AI, and blue-collar labor is getting turbocharged and transformed by AI. And you're going to have an explosion of diversity in products and productivity. Our role is to improve, to digitally transform and improve the economic system of the world. So digital capital is a better foundation for credit than physical capital, and digital credit is better. And so the result presumably is weak credit issuers will get squeezed out, and all around the world where people are suffering from financial repression, there'll be less, and probably the credit rates of other instruments will increase over time, and as those credit rates increase, the decision making of the borrowers will improve because the cost of capital will change. And so I think the world will be more rational and will be a contributor to it. But otherwise, there's still going to be a lot of diversity and a lot of innovation going on. And probably the world will be evolving across 100 dimensions much faster than it is today. Instead of having 50 million people or 20 million people engaged in basic research, maybe you'll have 1 billion people engaged in basic research in 10,000 areas that we don't even think are worth researching or we can't afford to research right now. So I'm not worried that there's a collapse. I think rather there's an explosion in productivity and rationality and opportunity and optionality. And the world won't be perfect either. There'll still be imperfections, but it'll be a better world than it is now. And there'll be more opportunity for everyone, and more rationality will be, spreading from here to there.
Yeah, 2 million Bitcoin is still really just 10% of the Bitcoin in existence. It's a lot, but it's not that much. There are companies that own more of the search market, more of the mobile phone market, more of the electric car market. And in 30 years, there will be new markets that open up. We'll be worried about how much real estate's on Earth. There will now be real estate sold on the moon, and somebody will go grab 20% of the real estate on the moon, and people will say, is that too much real estate? And I think there will be new markets, new products, new capabilities. AI will be around, humans will be around, society will be around, and innovation will continue. And by then, we'll have 10% of the Bitcoin, and maybe there will be a brand new category of product that we've never thought of, and maybe we'll have innovated in that space too. 2060 is a long, long time away.
Thank you, Ray Du. Our next question comes from Christopher Adoc.
Awesome. Thank you for taking my question. My question is, if Basel moved Bitcoin to Group 1 tomorrow, no other changes, do the big banks that you've been meeting with recently, do they start buying Bitcoin all of a sudden, or do they need proof that the consumer demand is there? Because there's a dichotomy of the products that are being rolled out versus them holding on their balance sheet. I was just curious on your experiences with the banks and your thoughts on the Basel rules and how they should or may change in the future.
I don't think it's overnight. I think Basel is an important standard because it'll open up banks, insurance companies, pension funds, and others to holding Bitcoin, to holding MSTR, other Bitcoin treasury companies. It'll help. It's not as existential, right? It's just another sort of barrier to overcome, like FASB, fair market accounting, right? We'll overcome these things, but I don't think it's existential. I think what's going to cause Bitcoin to grow fast is, and we've talked a lot about it, corporate adoption, which has happened in the last year, banking adoption, which we'll see happen this year. I think when those things happen, the distribution channels of Bitcoin and digital credit will increase, and Basel is just one piece of it. And we'll fix that, but you know, Bitcoin doesn't have these existential things that keep it down or step function things that are going to cause it to grow overnight anymore. It's too big an asset class and too much support in the government. So I think it'll be helpful, but it's not necessary. And on the flip side, it's not going to just cause an avalanche of investment either.
And there's no one milestone. There's going to be a progressive adoption everywhere in the world, quarter by quarter, for the next 40 quarters. And when 40 quarters have gone by, it will be deemed to be, you know, cool and new, kind of like the iPhone in 2020. Be like, well, you probably have a digital account or you have a digital asset or something, don't you? And banks that don't handle digital assets, you know, 10 years out from now will probably be deemed to be, you know, traditional, quaint heritage banks. Like kind of like when you go to the boutique bed and breakfast that is styled after the turn of the century, whatever, and it'll be something like that. But it'll be 10 years of just progressive adoption everywhere in the world, and then it will be new and cool and modern.
All right, so the next question we have is from Chris Ritter. Chris is here.
Thanks for taking my question. Strategy is pioneering a new world of digital capital, digital credit, digital money. My question is, what role infrastructure-wise does the Lightning Network play in this new world?
I know Lightning is, you know, one of the layer 2 protocols. It's not the only layer 2 protocol. I mean, for tech forward companies, digital wallet companies that want to create really cool apps on a mobile phone, and if they want to do things that are high speed, low cost, they'll probably look at something like Lightning to do it with. And Lightning may be a high frequency, low mid security settlement layer between a bunch of digital assets players that want to swap Bitcoin around. But there's going to be a lot of other types of products that don't require it. I mean, it's quite possible, for example, I just wire $100 billion to JP Morgan and they just pay me 8% and they buy a bunch of digital credit with it. And I just collect the 8% and then I give it to my heirs. And like, there is no transaction for the next 100 years. It's like that will probably be a more economically consequential thing. So there's a lot of interesting things that will happen in the space that don't require layer 2s. There'll also be layer 3s that will form at some point. I wouldn't be surprised if you don't see, Zuckerberg roll support for Bitcoin transactions on WhatsApp or Messenger or any of those networks, and you could see it get built into the iPhone and it moves on iMessage. And so they're going to be layer 3 protocols. Lightning is going to be a layer 2 universal protocol. There's going to be, there's always going to be the Bitcoin base layer, and there's going to be a competition. I happen to like Lightning, but I don't think the success or failure of the digital asset future relies upon any one particular layer 2 protocol or layer 3. The only protocol that really is critical to us is the layer 1 protocol, which is Bitcoin. And so the thing that we need to defend, with all of our hearts and souls and all of our intellectual energy, and we need to protect and cherish, is the layer 1 Bitcoin protocol. As long as that isn't corrupted, then you can create a $100 trillion economy on top of it. And then every other, like right now, if you look at, right, the blocks are not empty. Transaction fees are at an all-time low. There's plenty of bandwidth. That's because the rest of the free market solves the problem of transactions by transacting on layer 2s like Lightning or on layer 3s, whether the layer 3 is an exchange or something else. So I think that there's going to be a very competitive market in layer 2s, and there's going to be an insanely competitive market in layer 3s, and they're going to they're going to create every piece of functionality and bandwidth we need, and they're going to be in a never-ending war with each other. I mean, you're even going to see the crypto networks like Solana and Ethereum and Hype, and they're all going to compete to be a layer 2 to move Bitcoin around one way or the other, or a layer 3 if you want, depends on how you deem them. And so technology is going to evolve. It's really the core base layer of layer 1 from which all value flows. And as long as the layer 1 is protected and not corrupted, then the rest of the ecosystem would be very healthy.
So the next question we have is from Tom White.
Yes, hi. Could you address concerns regarding shareholder dilution from further issuance of shares of common and preferred? Thank you.
Yeah, that's primarily just a short seller narrative or a Twitter troll narrative, because by people that aren't very well informed. We don't do things that are dilutive. We do things that are accretive. So whenever you issue shares, whether you swap them for Bitcoin or swap them for money, if it's a good idea, it's accretive. If it's increasing Bitcoin per share in the near term or the long term, it's accretive. If it's diluting Bitcoin per share over the near term or the long term, it would be dilutive, right? In all cases, for the history of the company, we have never done a capital markets transaction that we believed was dilutive or would be dilutive over the long term. Occasionally, 1 in 20, 1 in 50 transactions is short-term dilutive in order to be long-term accretive, but very, very rarely. So we will occasionally take a slight dilution in Bitcoin per share or assets per share in order, and in all cases, it was to improve the credit worthiness of the company. Because if we didn't improve the credit worthiness of the company, we created a reflexive lack of confidence, which would be long-term equity negative. But as a general rule, everything we're doing is equity positive and credit positive. If we do anything that was dilutive to the equity, it would be dilutive to the credit rating of the company. And so doing things that are not equity positive or bad business for the credit, doing something which is credit negative is bad for the equity. If the creditors lose confidence in the credit lines dry up. That is, no one wants to buy the credit instruments like STRC. That's bad for the equity. So sometimes you would do something which isn't immediately screaming home run for the equity, but it is long-term good for the equity because it's good for the credit. And we balance the interest of the credit investors and the equity investors in every capital markets transaction. But as a practical matter, you can literally track the BTC gain. It's on our website. We update it every week. You can look at the BTC yield. We update it every single week. If the BTC yield in any given quarter or year or particular period is more than zero, then all of our equity transactions are accretive. They're not dilutive. So issuing of shares is in and of itself not dilutive. That's a sloppy use of the English language, right? When I issue shares in order to create shareholder value, it's an accretive transaction.
Yeah, I think it's just sloppy is a pretty good adjective. We've been very clear. Our goal, what we consider accretive, is increasing Bitcoin per share. So if someone thinks the act of issuing equity is dilutive, then they're just misdefining what is dilutive or not. Or not. It's like saying a company that is growing 200% but has negative income for 2 years is losing money versus growing as a company, right? They are early stage companies looking for revenue growth. That's the objectives. And so you have to understand what is the objective of our company. Our objective is to increase Bitcoin per share. We are as transparent as any company possible as it pertains to that metric. We update every single week what our Bitcoin per share is, what our Bitcoin yield is, what our Bitcoin gain is. We talk to all of our active shareholders, our top active shareholders, Capital Group, Morgan Stanley, Fidelity, they all understand. And so I think it's just really either somewhere between misinformed and just trying to get hits on X to say that it's dilutive at this point in time.
I will say two other observations. One is I think we're the most shorted stock. I read we're one of the most shorted stocks in the stock market. That's because a lot of people are hedging the converts and I think that the narrative that we've done anything dilutive is coming only from people that are short the stock. I personally have met with hundreds and hundreds of stockholders. I've never met a shareholder that thought we were doing anything dilutive that was long, that was actually holding the stock. So this entire narrative is only from people that either don't own the stock or are shorting the stock, hoping that it will go down. And so it's an ironic proposition. Our long-term goal and expectation is we'll double Bitcoin per share over 7 years. But if you look back, we had a 74% Bitcoin yield 2 years ago and a 22% yield last year. So the company's actions have been screamingly accretive, and they will continue to be accretive.
So, Phong, a question for you. Yesterday, Michael showed us the 3-layer model with Stretch as layer 2, digital credit, and everybody saw that with yielding over 11% with the 22% volatility. Layer 3 above it, digital money, has a goal of near zero volatility. So when you think about Stretch's position in that quadrillion-dollar global asset chart that we see from Jesse Myers, right? $370 trillion in real estate, $320 trillion in bonds, $135 trillion in equities, $130 trillion in money, $35 trillion in gold. How do you see layer 2 fitting into the institutional portfolios, allocating to each of those buckets? And how does layer two's role evolve as layer three develops in the future?
Well, I'd start with that. I don't think layer two and layer three are necessarily mutually exclusive, right? There are people, one very simple way of thinking about it is if you have money that you need immediately, you need 1 month or 3 month money, right? You probably want to put it into layer three, right? And that individual or that institution or that corporation that has 3 month money that they want to spend, typically right now are just holding it in some form of a money market, right? Or if you're lower income, lower assets, you're holding it in a checking account, right? And you want access to that money. You want to know that it's going to be perfectly stable so that when you have to pay your rent, or if you get in a car accident, you have to fix your car, or your AP is running a little bit high and your AR is running a little bit low, that you want to have 3 month money, right? And that's where layer three comes in. Right? That same individual, that same corporation, that same person, that same family, then has everything between 3 month money and call it 4 year money, right? And maybe you're saving that's for you to put as a down payment on a car, or you want to buy a nice refrigerator, or you're a corporation and you want to grow and you want to hire another 100 people. That's what Stretch is perfect for, right? And in that particular case, right now, where are they holding it? They're also holding it in a checking account, or they're holding it in a money market, or they're holding it in a T-bill. They might be putting it into private credit, which I wouldn't do, all right? Maybe a corporate bond, and it replaces that. So it's the same individual, the same corporation. It's just different asset allocation. And of course, then the perfect scenario is that individual or that corporation or that asset manager has money that's greater than 4 years out. And that's where Bitcoin comes into play. The first two categories represent somewhere in the category of $300 to $400 trillion worth of money, right? But it's the same person that should be holding all three, layer one, layer two, layer three. They just serve very different purposes. And it's primarily a duration.
And don't you think with the illiquidity of private credit in particular, which may have a little bit more yield, but way higher risk, and you actually can't access your capital. I mean, it seems like that's a perfect avenue for Stretch right off the bat.
It's a perfect avenue, and I don't understand why people buy private credit personally, right? I've been pitched so many different private equity investments where they lock up your money for 4 years and they charge you 2 and 20, and maybe you'll get 15%, or maybe 20%, and of course you get taxed on that too. The reason people buy it is the distribution channel gets paid a lot of money to sell it, right? And so the distribution channel, whether that be private equity, and they have an entire group of people selling out to wealth management and other tiers, that's the reason why people are buying it. And when you have a 4-letter ticker that you can just go buy on the NASDAQ that offers significantly improved characteristics, right? It's shorter duration, better maturities, it's higher yields, it's tax deferred, it pays you monthly. It's just sort of, it has to, like anything, the issue and why I get obsessed talking to banks and others is the distribution channel is controlling who's buying what, right? Which is why I thought it was brilliant that Apple created the Apple Store after they went through the carrier, right? And why Tesla started distributing directly and disrupting. And it was regulatory, hurdles, or Uber decided to go straight to give people rides without having to get a taxi medallion, right? We think of these things as sort of cute and novel, a taxi medallion, or even now a car dealer. Well, right now the distribution channel owns distributing private credit. 10 years from now, we'll think of that as cute and novel because people will be able to buy securities, not just on the NASDAQ, but 10 years from now, they'll be tokenized. You'll be able to do it right on your phone, or you might, chip implanted in your brain. You just think Stretch and it just appears, right?
I think anybody after this conference is already happening.
Yeah. So I think there is an opportunity for disruption with the product, but there's also an opportunity for disruption with the distribution channel.
Yeah, we may have time for just, if you have time for your question, it is a perfect lead in to your question.
Well, we actually have a final question. Every room I walk into, every table I walk by, everyone's talking about AI, artificial intelligence, Claude, ChatGPT. And we know that AI was deployed to help you create your preferred instruments. So I just wanted to know from both of you, how are you personally using AI in your workflows, and how should other business leaders deploy these technologies?
Yeah, I'm using AI for everything we do in the capital markets. So we used it to define, to design strike, strive, stride, stretch, stream. We use it to decide how to manage our capital markets programs. So we're using it in order to work through the monetary engineering and all of the digital engineering issues around digital income, digital yield, digital money, and we'll continue to do it primarily because you've got a mixture of financial issues like frequency, like for example, how many days is it, before what is the logical frequency of liquidity on stretch now? Right. You wouldn't have to wait more than 4 weeks to actually get your money back on stretch right now. But as the liquidity builds and the volatility falls, that time frame goes from 4 weeks to maybe 4 days. And to Fong's point, we're thinking about the frequencies of money and the frequencies, and we're thinking about the harmonics of risk. So I use it a lot to think about risk, credit theory, monetary engineering, and then use it to design digital money, digital yield. Think about how it compares to everything else. We use it to analyze the private credit market and all the other credit markets and the like. So for me, it's pretty strategic in capital markets execution, securities design, strategy, competitive analysis, and communications. And so I think it's critical. The biggest I think question mark for me is just which various AI models should I use and which mode, and then how frequently should I reconsider whether or not it's still the smartest one? Do I need to it's like we used to actually redo the RFPs with our vendors every 3 years, and then it was every year, and you kind of have to redo the RFP with your AIs more and more frequently because there are just more and more capabilities, and you have to reconsider whether or not you need to reprogram the way you do work. But otherwise, I find them to be pretty transformational. And stretch wouldn't exist, digital credit wouldn't exist without AI, right? I mean, I can say that very unequivocally. None of those credit instruments, and when you finish the credit instrument, you can see there's one that's better than the next, and then the next is better than the next. And when you get to the best one, I used to be known for that phrase, there is no second best, right? You find that there really is no second, there's a best. And when you find the best, it's so much better than everything else. You think, why did I even ever waste my time doing the other thing? And the real contribution of AI is it helps you move from the third best to the second best to the first best. And then when you've got something that's really good, it helps you figure out how you make it better.
Yeah, there's really not anything that I do that requires thought that doesn't go to an AI in parallel. Meaning, if you think about our legal department and our government affairs, I have an accounting question I would used to go ask our accountants. Now I ask the AI, and then I would ask our accountants. If I have a question about, we talked about Basel, we talked about MSCI, like, how did I figure out how these things work? I go ask the AI, and then I go ask the lawyers, right? And then you go to finance, you go to HR. If I have a question about what's an HR policy, external, internal, what do other companies do? I go ask AI, then I go ask the HR team. And sometimes I don't even ask the team because the AI is good enough. So people probably see I pester them a little bit less. I ask them fewer questions. And then you go to areas like marketing and, our videos and a lot of the stuff that we're doing in marketing now. Translations. We used to spend millions of dollars a year translating all of our code, all of our marketing materials. When I joined the company, we had 14 languages. We decided to go down to seven languages so that we could cut our translation costs in half. Now it just doesn't matter anymore. So our engineering is 4 times more productive than it used to be. And to Mike's point, the hardest thing is trying to keep up with the technology at this point. It's not using the technology, it's trying to figure out which is the better one, which is the best one. Because you ask the AI, which is the best AI, and I'm not sure I trust that answer quite yet, right? But it's just, what is the best technology? And that's actually fun, right? As technologists, I like seeing what's out there and seeing how quick it's moving and everybody's studying it. That part is exceptionally fun, but it's crazy. Not every now and then you'll ask some of your vendors, some of your partners, like, an attorney that you're working with, do you use AI? And I think they want the answer to be no. I think they're worried that we're feeding, they're feeding our privileged information into the AI. No, not worried about that at all. Worried that they're not using AI and they're going to bill us 10 times the number of hours that they should. So I love it.
There's one other point worth making, which is before AI, there was a tendency to create a team, an accountant plus a lawyer plus a marketing person plus a finance person plus a tech person plus the business executive. And now the geometry of work is morphing into, it's like the CEO or the single business executive, a domain expert, and the AI. It's like, it's like I want the artist, and then me, and then the AI, and the teams are really teams of 2 plus an AI, and it was teams of 5, or and so the team structure is collapsing almost to like duopolies. Like you need the domain expert, right? Or the practitioner, the one lawyer, the one artist, the one programmer, the one something. And then you need the business person to say, this is not worth doing, or this is, with the taste is like, we're going to take the risk or we're not going to take the risk. I want it, I don't want it. But, if you take those 2 roles, the expert or the domain expert, and then the business expert or and then the AIs just do all the work. It's like the robots do the blue collar work, and the AIs do the white collar work. And so we've consciously worked to slim down teams it's like just me and you. And it's not me only, because the AI is not quite good enough to replace the domain expert. And hopefully they won't ever, because if it's just me and the AI, it's a pretty lonely world. I think.
You and Claude.
I'm thinking 2 is a good number. But there's a lot more things where it's like, I'm going to talk to that person and the 2 of us together will work it out, and the AIs do all the heavy lifting. And there's a lot more of that. 5 years ago, it didn't work that way.
Yeah, you need the 21-year-old who really knows how to run the AI and is unafraid, and you need the person who has some business experience who's going to say, no, don't do that.
Yeah.
And everyone else in between has to be worried. And I see this at times. There's a lot of anxiety when when Mike goes and talks to a junior person in marketing, everyone's like, what's going on? They get all anxious, everybody in between. But that's how business is going to get done. So you have to then become one of those 2 people or one of those 3 people. That's how you're going to create value, not sitting there getting anxious and being like, what did Mike say to you? Right? Like, and then creating friction. And that's what's happening right now. But it's so much more productive and it's so much more fun.
Totally. Those are such fantastic insights. Make sure to get to know these skills. You need to be able to know how to deploy AI. It's been so wonderful to hear from both of you. Thank you so much. AI and Bitcoin are a powerful combo. You 2 are a powerful combo. Thank you so much for joining us. Everyone give it up for Michael Saylor, Phong Lee, and James Lavish.